I have the distinct pleasure of talking today with Mark Duffy, president of Mountain Pacific Bank, headquartered here in Snohomish County. I've asked Mark to come in and discuss the pending Fed rate increases for 2022 that we're all hearing about. Mark is on the front lines as a regional banker, so you will want to hear what he has to say. In short, he's got his pulse on what's going on. Mark and I go back a long ways, some of them scary experiences from 2008, but we'll let Mark talk about some of that. And at this point, I'd just like to turn it over to Mark so Mark can introduce himself.
I'm Mark Duffy, President and CEO of Mountain Pacific Bank. We were started back in 2006, headquartered here in Everett. We are almost $600 million in assets. We did exceed $600 million at the end of the year, but have dropped a little bit below that. We have 4 branches. Our branches are located in Everett, our main office, Linwood, Ballard, and then Burlington. We focus primarily on business and high net worth individuals, but also do consumer lending and consumer deposits. So we're a local bank. Decisions are made locally, and we survived as Dave talked about, the Great Recession back in 2008. Dave helped a lot during that time, but it was I used to have hair back then too.
Well, if we go back to that time, Mark, and we'll segue just a second, but, there was a lot of banks that were here in 2007 that are not here today. I've always said, it was you 24/7, and we had some fortuitous things happen, and some very wealthy board members that were able to step up. But I really go back to 24/7 of your life, working. I mean, I just remember the hours you were putting in. And let's face it, the FDIC was not friendly.
No.
So how many banks were here in 2007 that aren't here today? Do you have a number?
So I got that always in my head. So when I started the bank back in 2006, we opened in July of 2006. There was 99 banks headquartered in the state of Washington. Today, there's less than 40.
Wow. So more than half are gone.
Yeah. And in Snohomish County, there was 14 banks headquartered in Snohomish County. Now there's 5 banks headquartered in Snohomish County right now.
Yeah, so we're down to a third, basically, of what was here.
Yeah.
And, you and I talked about those times and how just terrifying they were, and, the heavy-handedness of the FDIC and a lot of things that you had to strategize and navigate around just to get us to where we are today. So, again, kudos to you, as always.
Thank you.
Yeah. Why, I'm gonna ask a couple questions here. Like, the first one is going to be, like, why do you think local banking is important?
The thing is that local banks will look at the whole picture, and what I mean by that is they won't just look at the numbers. Yes, we look at numbers, and we do that too, but we will also look at circumstances and make a decision based on all factors. One thing might not fit what we want to do, but then the rest will make sense and mitigate maybe any risk that might be there. The other thing too is the smaller the bank, the closer the decision makers are. It's pretty simple. The bigger the bank, the decision makers might be out of state or might be down I-5 somewhere. So that's helpful. And the key to that is not all banks are perfect. No bank is perfect. Everyone makes mistakes, including Mountain Pacific. If there's a mistake, who are you going to talk to? Somebody on a 1-800 number or somebody local? With Mountain Pacific, you're talking to somebody in Everett, and the decisions are made here in Everett. So the other thing I always tell people to try to do is leverage their banker. Attorneys and accountants charge by the hour, where a banker, we don't charge by the hour. We can't give legal or accounting advice, but we might direct you as to looking at things, and we'll always say, when it comes down to the final decision, to talk to your attorney and accountant on matters. But yeah, we're there to help.
Yeah, well, and I remember, Mark, going back before, you were in that transition from bank to starting bank, and I remember sitting down with you, and just because as a young entrepreneur, let's face it, we were a lot younger then, yeah. But as a young entrepreneur, not knowing what I didn't know, and just having that relationship to be able to say, here's my financials, what should I be looking at, right? That mentorship that comes with that local banker that, has your back, because, it's a relationship. So I always found that as being one of the keys as being a young business person and being able to have that relationship and communication. And so I'm going to meet with a couple of your other senior VPs here over the next month, and we're going to do some other podcasts, talk about some of those things. But so we'll keep going. Yep. So let's talk about Fed rate. Supposedly the Fed's going to raise the rate that they're loaning to you as a banker at least 4 times this next year. What's that mean? What's that mean to you, and what's that mean to our local businesses and consumers? How's that play out?
So, when the Fed raises rates, the prime rate goes up. It goes in conjunction with it. There's always a spread between the Fed and prime rate. And so if you're borrowing on a variable rate, that'll be affected by it. So construction loans, business lines of credit, personal lines of credit will be affected by it. Longer-term borrowings, a lot of times they'll go up before Fed funds because the market will take that into consideration and raise rates based on that. So we're already seeing that. We do a lot of commercial real estate. We don't do mortgage loans in our bank. We do commercial real estate loans, and a lot of what we do is 5-year rates. And the 5-year rate has gone up dramatically. It's gone up 75 basis points roughly in the last month and a half. And I think it's all the market seeing how inflation was going and, the Fed talking about raising rates and stuff. So a lot of that's been priced into it. The war now has made it very volatile. It went up, a little bit, and then it just came back down today over 10 basis points. So I don't think anyone's aware of it, but a lot of times the market on the longer term rates will take into consideration all these different things. But the Fed funds, once they do it, everyone is expecting them this month to increase them by 50 basis points, will affect more short-term borrowings and not as much long-term, because I think, it might still affect long-term, but I think a lot of that's already been priced into the market right now.
So for the public's education, you as a banker or bank, you have this opportunity to go to the window, right? The Fed window to borrow money, right? And so when you're out there borrowing that money from the Fed, you're borrowing at an X amount of rate, and then it comes in locally, and you're going to loan it back out at Y rate, right? And so that's where this impact comes in. You mentioned construction loans, commercial loans, different than a mortgage. When you get a mortgage, it's going to be 30-year fixed, right? But a commercial loan termed out at 5, amortized over a longer period. But that gives you the opportunity as a local banker to do what? Kind of readjust after 5 years.
Yeah, so we fix it for 5 years. So majority of our commercial real estate loans are 10-year loans, 5-year fixed, and then they will readjust at the 5-year mark for another 5 years fixed based on a spread. We don't borrow as much from the Federal Reserve as we do from the Federal Home Loan Bank of Des Moines. There used to be a Federal Home Loan Bank of Seattle, but with all the changes and consolidation that even happened in government agencies, so the Federal Home Loan Bank of Des Moines is where we borrow if we need to borrow, and they have a 5-year rate that we tie everything to. So they have various rates that we can tie it to, but the majority of our borrowings are 5-year fixed.
Okay, very cool. So the question that as a mortgage person, I get asked a lot is, why? Why this, why that, particularly with mortgage rates. But, and then also looking at why is the Fed raising rates now? Do you see that as a good thing or a bad thing overall?
Depends on who you talk to.
Whose perspective?
Whenever rates move, the borrowers, the people that are borrowers are happy when rates go down, and they're unhappy when they go up. And then the savers are the ones that are unhappy when rates go down and are happy when rates go up. So, basically everyone has seen what's happened with inflation. And so the Fed has to do something to try to cool the economy. There's been a lot of stimulus money due to COVID put in the marketplace. Probably some that may not have been needed. I know a lot of it had been needed, but probably towards the end, some people didn't need it as much. So I think they need to cool things down. So that's part of their plan. They've been investing in the market in bonds and stuff, and they're trying to divest themselves a little bit from that. So that'll affect interest rates. So that's what's affected interest rates. They've already done that, but it's to try to slow the inflation because it's as high as it's highest it's been in a long, long
I
time.
think like 40 years,
Yeah.
right?
So
I think it's the
it's-
last number I saw.
It's significant. And, the economy has been, I'm not sure what total effect it's going to have. I'm already, I talk to business owners a lot. They've been having difficulties anyway with labor, trying to find labor. The cost of things has gone up. We all see it, and so do the business owners. And the supply chain has been an issue. I was talking to a guy who does racking he's a rep for racking company. He said his biggest competitor, the company that he reps, their competitor is not taking any new orders till next year.
Yeah, and that's across everything.
It's crazy.
It's
how bad
widgets,
it is.
it's electrical stuff, it's housing stuff, anything to do with the house.
Yeah.
And the commercial side too. So I have this contention, so please correct me, but I have this contention that there's not many tools in the federal toolbox for our next recession. So if we don't put a couple tools back in, they don't have a lot of things that they can do to kind of stimulate when we get to that next recession. So to me, it's like, I feel like they need to get the Fed rate up, because when the next recession happens, that's the only thing they can really do to help you on a local level. To be able to lower rates back and entice, that business growth. And then the other thing was stop buying mortgage-backed securities, because they were buying them in billions of dollars of tranches, and now that they've stopped, when we hit that next recession, at least that tool may be back for them to step back in and help stabilize the housing market. So am I off, or am I?
No, you're correct. Yeah, right now Fed funds are pretty much at zero. It's 0 to 25 basis points. So it's they don't have room there. You can't lower rates. I know some economies have gone negative interest rates, which just hasn't worked and doesn't make sense. So that's why part of it, they need to cool the inflation, but then also, like you said, to have tools should the economy turn and they have another recession. This is another long period of time that we haven't, had a recession. So.
Yeah, but as you and I both know, 2008 lingers right here on my shoulder. So you already mentioned where our current branches are. So you've got Mountain Pacific's got branches. So it's to dispel kind of part of this. You're not just a commercial bank, right?
No, we do. When you start out small, commercial banking is probably the area you focus on more, because you don't have as many retail locations as the large banks. So it's difficult to be a retail bank. But as we've grown and moved into the Skagit County market, we've become more retail. We offer more consumer products and stuff, where before it wasn't our focus, because we just don't have the volume to compete with the credit unions or the large commercial banks.
Right. One of the things that Mountain Pacific does that's really cool, if you're a business owner listening, we're still running the mobile branch.
Yep. Yeah. So we go and pick up deposits at businesses. So we make it convenient for the business owners to bank with us. They're actually actual branches of the bank. We have to apply for a separate bank branch when we do apply for a local branch. So each branch we have in each market is basically 2, with the mobile branch and the bricks and mortar that we have. So yeah,
that's such a cool thing.
It's a great service. It is a huge retention tool. Our customers that are on it won't switch banks just because they're so used to it and they realize the benefit of it.
Well, and to spell that out, you're a small business owner. You might be a 1 or 3 person shop. You no longer have to make that run to the bank. The bank comes to you, picks up your deposits. They're FDIC insured when they come to pick them up.
Once we pick them up.
It saves you that trip. It saves the extra hour when someone decides that you got to go get coffee on their way to drop the deposit off.
Or they're dry cleaning. Yeah.
Or they're dry cleaning. So yeah, all those different things. It's a great savings, and I think just from a bank that started out small, what a great tool in the toolbox that you created. I think that was your innovation, if I remember correct. So we're getting close to wrap up. What do you see different? Because this is one of the questions I get asked a lot. What do you see different about now, what we're going through right now in 2007, let's say, in 2008?
Sure. So the big difference is, we got caught doing a lot of construction loans, and we were doing some crazy lending.
Like everybody.
Like everyone was, yeah. Because real estate was selling, and everyone locally, all of us were saying, real estate never drops in value. A bad real estate market means it doesn't go up in value. So, and then also I think the biggest thing was the ease of being able to get a mortgage and buy a house, and that was the problem. You didn't have to qualify. You just had to, and there was a lot of things going on, and you understand it more than I do. The process now is much more difficult for somebody to get a mortgage.
We're not fog and mirrors.
They have to prove that they can afford it. So that's the big difference. It is scary the way real estate has gone up. I just keep shaking my head as to what I've seen in this market, but it's not a bubble in my opinion, just because the people buying it have to prove that they can afford it.
Right.
So.
And we have such a dramatic supply and demand issue when it comes to real estate.
Right.
Not only locally, which is really exacerbated by getting lots created in the first place, but we got wetlands, steep slopes, all those things that prevent being able to go out and build like you can in Texas,
Phoenix.
Or Phoenix. Right?
You drive around Phoenix and it's just amazing.
There's another city popping up in Phoenix, right? I mean, just outside. So yeah, we have those constraints, but again, we're such a supply and demand issue with what we got going on. It terrifies me as well, just from our borrower standpoint, and being able to, how do they keep up?
Probably the biggest thing, the difference is, last time we were blamed for it. This time we're not being blamed for it. Us bankers and mortgage guys we're blamed the last time.
Yes. So we're not going there this time.
Yeah, no.
So no, I appreciate that. Well, Mark, we're finishing up. Any last thoughts you want to throw out there? I appreciate you coming in.
Sure.
Taking time out of your busy day. So again, thank you. Everybody's watching this. Mountain Pacific Bank, again, regional here, headquartered in Snohomish County. Really great people down there to talk to. And if you want that feeling kind of like Cheers where you walk in and people know your name, that's what you get with local banking.
Yeah, definitely.
Well, Mark, thanks so much.
Yep. Thanks, Dave.
Okay.
Appreciate it.
Yep.